traders, welcome to this Elliott Wave Street update. It's a pleasure to be with you today. We are going to check the live markets. We are going to plan some good trades, and we are going to start with the euro. So here we are on the euro. This is the live market, and the price has been bouncing several times from the lows. So actually I'm going to make my first attempt to go with the trend. I'm buying the euro. I already notified my clients what I'm doing, and let me show you the strategy and let me show you the risks, and we are going to make a deep analysis on the dollar to understand what's going on. But my trade on the euro is to go long. It's my first attempt. So look, first of all, we are seeing on the euro the price reaching lower lows. So here this is a pivot, this is a second pivot, this is a third pivot, right? And one key difference that we can have here is to have the price losing momentum. But what's the meaning of price losing momentum? Well, if we check this distance from here to here, we have a random distance, right? Right there we don't have anything. But if we check from here to here, we are seeing that this distance is decreasing. And if we check this distance over here, from here to here, we're seeing that it's getting smaller. So every time the price moves lower, we are seeing the price having trouble, right? We are seeing the price having trouble because we're seeing that the price is not breaking support, is not accelerating, right? The price is losing momentum. So what's the meaning in the institutional world when we are seeing the price doing this setup, right? The meaning is that the price, when it's doing this setup, is that the institutions are absorbing everything, right? They are absorbing everything. So because they are doing this absorption, it means that the volume is likely to be low. In the forex market, we can't have on the forex market the volume, right? We can't have that. So that means that when we are seeing the price losing momentum, is the volume is getting smaller. That's one way to try to bring the volume on the forex market to the charts. Because if the institutions are buying everything, actually what they are doing here, once the price makes a lower low, they are buying. We're seeing demand, and we're seeing demand here and here and here. So they are clearly absorbing. This is accumulation from the Charles Dow theory. They are doing accumulation. So the plan is that after they do all this accumulation, then they have this cycle, and that's demand. So they are buying so much euros So they are buying and buying that they push the price higher. And then they try to check who is in these areas in order to bring the price lower again, because that's their game, right? And if they don't find more sellers, they can start buying from here, and that's where the magic can happen, because that's where the magic can happen, because because we have the buyers, the demand. So the question is why we are seeing the price doing this demand here. You know, if they can very easily push the price lower, why this time we are seeing the buyers entering the market here? Right, this time they are showing buyers here. So that's why I'm going long. Now, this is just a small picture. This is the trigger picture. And of course, the stop loss, I'm going to leave the stop loss here just in case, a 1% stop loss, a 1% of the account, just in case they want to do it again, because I'm going to explain the dollar thing in 1 second. But before we go to the other details on the dollar, let's have a look at the big picture. This is a weekly chart. I have been trying to find the bottom of the market. Actually, I was thinking here that this was the bottom of the market and that the euro was ready to start climbing. And I make a trade. I like to trigger at the lows, so I have an advantage because I was able to move my stop loss to break even and everything. But to be completely honest with you, I didn't expect this leg down. This extra leg down was a big surprise. I didn't expect this one. I was expecting something different. I was expecting at that moment something like 1, 2, 3, 4, 5. That was my plan. Back to the highs, right? So this was a big surprise. But anyway, I believe this is a better discount. You know, this is a better discount in the market. And one of the advantages of, or one of the edges of triggering the trades at the best price possible is that we have room to do a lot of things. But let's see this setup from a different point of view. Now let's go to the bond market and let's talk about the dollar, the US dollar. The Fed these days is having an interest rate between 0 and 0.25. That's the Fed rate. What is happening with the market? You know that when the bond is going down, the yield is going up. So these days, what we are seeing in the real life in the market, we are seeing the price, the yield on the 10-year bond at 165. 165. And the Fed rate is at between 0 and 0.25. So 165 is the market rate. Usually, under normal economy, we are going to have these two rates, a little bit apart, a little bit close, but roughly the same or roughly close. Of course, with some days with some difference, but not that huge. So this difference between the Fed rate and the bank rate coming from the bonds is huge. Of course, this is fantastic for the banks because they can borrow from the Fed at this rate and they are going to put the money into the market at this rate. So this is a huge gain for the commercial banks. They can make some good money. But this difference needs to start needs to start decreasing the difference, the spread. And there are two ways. Of course, the Fed increasing rates plus the bond market decreasing rates because the spread is huge. So my plan here is that I believe we are near the bottom of the market on the bond, on the 10-year bond. So when the bond starts climbing, once we see the bond starts climbing, we are going to start seeing the decrease in the rate. So at the same time, the dollar will start decreasing because the dollar is so high thanks to the interest rate that is at the 165 is really high. At higher interest rate, we are going to have the price on the dollar going higher. At lower interest rate, the dollar is going lower. Right? That's what actually really moves the market. The difference between rates. So if the bond market starts the reversal, this actually could be the low, why not? This could be the completion of everything and we can start seeing a 5-wave sequence. What is going to happen with the dollar is that it's going to confirm this is the top of the market, right? So if that's the top of the market, then we just need to follow the reversal, and that would be a fantastic trade. But that's the risky part, the volatility at the end. But we need to start trading. We need to start trading. We know with a high probability that the price is going to reverse and it's going to start going down. But the question right now is timing. Right? Timing is the key part for this setup. So I believe the market is ready. Let's have a look at the 15-minute chart here on the dollar so we can have a better understanding here. Right? So we are seeing the price rejecting the highs. And what's the logic? What's the logic behind the price rejecting the high? What is happening here? Clearly the market is failing. Clearly the institutions are aggressively adding to their positions. But the thing is that the banks, they don't care if price breakouts or not the high. Again, because they are just using the good price to sell. We are seeing that behavior. And if the price makes a hard high, they will sell it again. And this is the distribution or short accumulation process. Right? And that's the tricky part when we are finding the top of the market. So if everything works well, we could be at the bottom of the market in the euro, and it has potential for a strong move up, but we are depending on the bond and we are depending on the US dollar, of course. So that's the tricky part, but I'm looking for a big move on the euro. If this is not the one, then the next one, by the next one I mean the price making a lower low somewhere here and then rejecting, and that will be another entry. But I prefer to close my trade with a 1% loss than having a loss active, maybe with a higher risk or a lot of points. I don't want to get trapped in this pattern, right? So let's have a look at another one. Let's have a look at the S&P. The S&P is fantastic. The S&P is fantastic, and we could have for Black Friday a discount on the S&P as well. Look, this is the setup. The price on the S&P yesterday, before the announcement of keeping Mr. Powell as the president of the Fed, the market started to go higher. And we have the price almost hitting the 750. All right, good. But the interesting part is that the news were already telling that Powell was going to be for another 4 years in the Fed as the Fed president. So it was like clear that he was going to win the election again. But once it was confirmed, the price on the S&P rejected it strongly and it started to go lower. Right? So the thing is that here we can see some manipulation because we are seeing the price rejecting the highs. But the most fascinating thing is that as traders, we are not going to buy here. Make sense? There is something that I like to tell my clients. Okay, so where should I look for a buy trade if it's not at the highs? If you are telling this is an extremely bad idea, yeah, you can make a home run eventually buying at the breakout of the resistance at a really expensive price, and yeah, why not? Maybe in one trade the price can break out this resistance, and the price can start gaining momentum, and it can go 1,000 pips, 1,000 points higher from here. Yes, can happen. I have a client. Last week I was doing a course, a Charles Dow theory course, and I was explaining this concept, and I have a client in the room that said, okay, with respect, I don't agree with you because I was able to buy the Bitcoin when it make the breakout of the 20,000 resistance. So what I did with the Bitcoin was telling my client in the room is, let's say that here was 20,000, the highest price ever at that moment, let's say. Then the Bitcoin did a retrace, and what my client did was, once the candle closed, I don't know in which time frame, above the highest price, he bought the Bitcoin. And he did a trade, and he kept the trade, or maybe it's better to say that it's an investment more than a trade. But anyway, the price then went to $60,000. So he said, I make a lot of money with that trade. So what you are saying that is a bad idea of buying when the price breaks the resistance, it's not true, because I make a lot of money, right? But actually, if you start testing out these type of trades, first of all, you need to have a huge stop loss, because not all of them are going to break out and are going to be directional. After that, you are going to have some noise that can move below the resistance, now acting as support. And the other problem is that is not the right way to trade, more than if it works or if it doesn't work. If you make a back test, you're going to see that most of the times it's not going to work. Eventually you can make a home run. But if you are buying, if you are investing, if you are trading, you need to buy here at the end of the corrective, buying at the lows. That's the right place to place a trade, because here you have an advantage. You have room to manage your trade, to make a safe trade, to take partial profits, to have a break-even trade. But when you are trading here, it's really tough. All right. So we are not going, at least with my technique, we are not going to go long at the breakout of these resistance levels. So clearly, Oh, so the technique that I developed to make this point better and to make it more educational is that we can split the screen in 4 parts. It doesn't need to be exact, just to roughly create 4 squares trying to be equally, but you don't have to make this with a tool or to measure. It's not necessary. Because when the price is on the right top corner of your screen, you can't buy. So in trading, we can buy, we can sell, and we can do nothing. Those are the 3 decisions that we can make. So buying is not an option in this area. So we can sell or we can do nothing. So it depends on the wave count, it depends on what we are seeing, it depends on the market structure. So in this case, I didn't do anything. Nothing was my option. And now that we are on the lower corner, right corner, here is where we can buy. So this is a good filter, because you are not going to buy at expensive price, or you are not going to sell at an expensive price. So this is the buying area. But then we need to create a projection, and we need to create an analysis, and we need to create a whole narrative of what's going on. And the next step here on the S&P is that if we have this consolidation, the price needs to move back to this area. So I'm expecting to have the price doing this 3-wave sequence, right? And check what is going to happen at this area. I will need to see some demand. So what's the meaning of demand, or how we can see demand in the chart? Well, it's really simple. Demand is a green candle, supply is a red candle. But the thing is that we need to check where supply or demand is showing up. Location is the next step. So if we have on the S&P the price coming down here, and then we have the candle, the green candle closing above this area, that's going to be the entry, because we are seeing demand at the lows. And that's the way how we can find the entry, by having a good setup. Right? It's actually simple. So that's where I'm going to look for a buy trade. I have been buying the S&P during all the retracements during the last year with SPY, also doing some trading, some investment. Well, let me tell you the difference between investment and trading, at least from my point of view. Investment is when you go to, I don't know, you check a stock. Let's say you check the Apple stock, and you read the news, and you start reading, oh, these guys are going to create an electric car. They are developing new products. I believe that in a couple of years, these guys from Apple are going to really make it. They're going to duplicate their sales. Let's say that you think that for like a fundamental reason. So yeah, you can go to the chart and try to find a discount, and you want to buy and hold that stock for 10 years, for 5 years, because you see a lot of potential, and you know that probably you're going to be negative sometimes, and then you're going to be positive, but you don't care because you are seeing to the long term, right? And that's investment. Same as a lot of people did with the Bitcoin, that they bought the Bitcoin at 10,000, 4,000, 2,000, and now they have a lot of money, but they are not trading They are just investing. But as traders, actually, we don't care too much the long term as the investors. Because as traders, we are going to get in, we are going to get out. It could be swing trading, where we can hold the trade. For example, I have a trade on the dollar CAD that I triggered on October the 20th. Or I bought the dollar CAD on the October the 20th, and I still keep the trade, but it's a swing trade. So we can have a swing trade for 2 months. It's a swing trade. Or we can have a swing trade for 1 day. Or we can have a day trade for a couple of hours, or a scalp for a couple of seconds. That's trading. That's not investing. So as traders, we need to react candle by candle, and we need to understand candle by candle. Let's have a look at another example that I'm following this week, and is getting closer to the entry, is dollar yen. So dollar yen is showing a good setup because it's actually the same dollar index trade. But look what is happening at the highs. This is another example why not to sell when we have a breakout of resistance. Look, what if we go long here? And we need to wait for the candle to close. Imagine buying there. It's crazy. The trade was here at this validation. Because look, we have a 3-wave sequence. The price moves below wave A, rejects, and moves above wave A, closing above wave A, or here, whatever, that was the signal, right? But we're not going to buy here. That's crazy. But we can sell, because if we divide, if we split the screen in four squares, we are in the selling area. All right. So the next step here is to trace a resistance line where the previous wave 3 finished. We are already seeing some institutional selling, which is good. And now we need to have the price exploring this area, right? So when we have price exploring this area, and if immediately or almost immediately, just with a tiny difference between the 3 and the 5, we have a reversal, that's going to be our sell trade precisely there. And the risk could be a couple of points above the high, whatever it is. The entry will be the candle close below wave 3. So this is the risk. And we have a huge potential. Just here, for example. Just here, we have a bigger reward than the risk. So we have an advantage. Because right there, we can do something. Right there, we can act. Right there, we can make decisions. We can move the stop loss to break even. We can take half of the position out to book some profits. So we have benefits when we are trading with the banks, with the institutions, because we're going to have an advantage than going for the break of resistance. You know, the regular retail trader will say, I'm going to wait for a move down, let's say, for a retrace, and then I'm going to sell once it breaks the support. And yeah, could work, you know, why not? But the problem of that trade is that where are you going to leave your stop loss? Here? So this is a huge stop loss. And yeah, you can have a 1% of the account no matter the size of the stop loss. But the problem is that in order to make at least 1-to-1, you need to have the same amount of movement And that's the part that is really complex. So in order to be successful in these markets, we need to have a tiny stop loss. Let's say that we want to buy. So we buy here. We leave the stop loss below the low, right? So this is the risk. And once the price moves back to the previous high, we are going to have the one-to-one in our trade. We are already taking profits as the banks. And we can have half of the trade after that, just keep open the trade, but it's already a safe trade. So we don't care, right? That's the right way to do it. Because on the other hand, let's say that the trader who is buying here, and he's not going to buy precisely at the breakout because he needs to wait for the candle to close. So let's say that he buys here, and this is now the risk. And in order to have a one-to-one, the trader will need to have a movement like this one, right? And that's going to be harder. Trust me, that's going to be harder to be successful like that, because the chances that that move happen are lower than the chances that at least this move is going to work in order to have a safe trade, right? So that's gonna be the plan on the dollar yen. Let's have a look at something else. Let's see what else is interesting. And don't forget that if you access our membership, you are going to get the full analysis, live market analysis every day. Let's have a look at the Bitcoin. The Bitcoin is showing that a price has been in this wave 1 and then wave 2 pattern, right? And it's telling that once we have the completion for this setup, or maybe it's done, I'm going to explain better how we can trade it, but we can have a powerful wave 3 after that. All right, so let's have a look from the institutional point of view what's going on. Look, we have price testing this area. What happened here? The price moves higher, yeah, of course, but what is happening behind the scenes? Why the price is moving higher? Oh, because we have a lot of buyers. It's not the reason. It's not the reason. The number of buyers is not the reason why the price moves. Be careful with that concept. The price is moving because the institutions are jumping into the market to absorb the sellers. So one institution, let's say Goldman Sachs, let's say JP Morgan, could be buying millions of dollars here from thousands of short sellers. So it's not a number of how many sellers or buyers we have here. It's in terms of volume, it's in terms of institution, it's in terms of liquidity. You know, this green candle, for example, this green candle could have a low volume because the institutions did a withdrawal of liquidity. Right? So the thing is that here at the lows, we were seeing that behavior of aggressive buyers. Then eventually they stop buying, they stop their process. They stop buying and they leave the price alone, providing little liquidity to see what's going to happen. While the price starts going down, they are buying. They are buying. They are buying, and they are aggressively buying at the lows, like buying everything. Oh, that's a good deal. I have to take advantage of this deal, and I have to buy everything. So they do that. They buy everything. And after they buy everything, they try again because they want to see the price coming down here again. As many times as the market have enough people selling there so they can absorb. But this time, the story is starting to change because look at these buyers. The price comes down, and before reaching the low, we are starting to see buyers. So this is a strong demand. So I was telling my clients this morning, this could be enough, this green candle, this tiny green candle. Let me highlight that one better with a different color. This green candle, the first one here after the red one, is extremely important for this story because it's telling that demand is going into the market before hitting the low. So that's an important hint. Actually, that could be the end of 2. So we can start our buying process. If the market makes another attempt, let's say like a nice Elliott zigzag ABC, well, even better, we can buy at a better price. But this is the story that we are seeing here. It's a bullish setup. All right, traders, so that's the plan on these markets. Now you can visit ElliotWaveStreet.com/membership. There you can activate your membership to receive my daily analysis, not only on these instruments, but in all the instruments we cover. So there you can find the plans. Thank you very much for being here, for watching this live market analysis. Have a fantastic week, a fantastic month. I'll see you soon. Take care. Bye-bye.